Hello and welcome. Thank you very much for joining me and welcome to the channel. So if you are a Walgreens shareholder and you're wondering whether it's to sell or hold, or indeed if you're wondering if Walgreens is a good buy, you've come to the right place. This is the video for you as I review the latest results released by Walgreens. I'm starting off with sharing with you my position in Walgreens to demonstrate that I've got skin in the game at what I've done so far. So I've bought Walgreens on 2 occasions in the last 12 months. First of all, in Feb 2021, and the price was at $49, and I bought around about £600 worth. I bought another £500 worth at $48 in July 2021. I'm a holder, and up until this point, I have been a big believer in this company. So the objective, at least from my perspective, is I want to understand, has the story changed with Walgreens? Now, so far, Walgreens has done absolutely fine. In just under a year, I made 11% return. That does include dividends within that figure. Yes, that's underperformed the FTSE 100 during that snapshot. That is less than 12 months. And if it carries on at 11%, of course, over a long period of time, that's a pretty good return. So the current holding is worth about £1,200, and that is around about 3% or so, or just under 3% of my £1 million challenge portfolio. So it is one of my larger positions. It's a decent chunk. So that's why I'm interested in Walgreens. So let's have a look at those latest results. So the top line is that Walgreens reported EPS from continuing operations of 168 for the first quarter 2022. That's fiscal quarter, 54% higher than the previous year. And it also is an outperform based on the Zacks consensus estimate. So they've beaten the analyst expectations in this case. You can see here that EPS was positive for 13, and it was a loss a year ago. So again, a good kind of year-over-year improvement. Generally speaking, I prefer looking at the year-over-year improvement. Quarter to quarter can fluctuate a little bit too much, and there can be overreaction to that, but I like to take a longer time period as the snapshot for that comparison. So if we look at the top line and sales, now sales are much higher, 34 billion. That's higher than the analyst estimates. And it looks like COVID, which was part of the original thesis, has been driving improvements in the company. So people going in for the vaccinations, testing, driving footfall to their stores. Now they have got sort of two arms. They've got an international arm and they've got an American arm, and we'll see a bit more detail on that in a moment. They have in fact reorganized their business on that basis. And in the US, 28 billion sales, 3.2% year-over-year improvement. So that's okay, although not groundbreaking. But comparable sales increase was much larger. Not much change in the pharmacy sales though, so that's not necessarily driving the increase. But retail sales increased around about 10%, so that's a strong performance. So we look at internationally, and revenues on a year-over-year basis were 36% higher. And there's a new JV in Germany which was driving that change. So that's really impressive, driving some growth. And there's been some good recovery here in the UK market, which has pushed forward their position as well. In fact, they've got quite a large share of the beauty market in the UK, which has done well for them over the long term. You see here the UK comparable sales 16.3% up. So that's a very strong performance. It looks like if we move on to the margin, so gross profits increased, as has the actual margin percentage, which is very important. And then the operating profit over 40% higher than a year ago, and at a higher percentage rate as well. So that's really, really pleasing. And they've got $4 billion in cash, which is around about 10% of their market cap, so it's a decent share. The debt, though, has increased, so we need to be aware of that. So to me, first of all, looking at those figures, they're certainly growing. Margin percentages have improved. Yes, the debt's gone up a touch. So we just need to be aware of that. But overall, the material story has not got worse, and it's kind of in line with roughly what we were expecting. So therefore, from my perspective as a shareholder of Walgreens, I will continue to hold on that basis. That's the view so far. There's nothing here that makes me change my mind as to what's happened. I'm looking forward, because we were looking back at that fiscal Q1 22, looking forward, they've actually increased their full year EPS guidance. They were saying no growth before, now they're saying low single digit growth. So that's the high level summary. We have a look at some of the metrics. We go to Yahoo Finance. So this is a company in the market cap of 43 billion, although the enterprise value is more like 75 billion. The trailing P ratio is just over 20, which is, for this sort of company, I think that's quite high. The 4P is actually 10, at the current price of $54. Now that's suggesting that going forward, you take into account what's expected to happen, they're actually quite decent value there for a P of 10. The other thing with Walgreens, one of the reasons I was quite interested in holding this is at the time of purchasing for me, the dividend was about 4%, and you can see here it's about 3.5% now because the price has nudged up a bit. 4% dividend on a company that is growing, but what wasn't really mentioned in the report we just looked at, but it's kind of in the background, and if you look at my previous Walgreens video, I went into more detail on this, is the management team. There has been a new management team in the last sort of year or so. I think Ross Brewer is the top dog now. And the management team and what they're trying to do seems really, really impressive. They've got some really exciting and what I think are feasible plans for sustainable growth. And just not in the traditional channels, but in also other areas such as the Walgreens membership and loyalty program. I think they're doing really well on this, and I think that's going to start feeding in to that bottom line over the next kind of year or two. So I'm expecting growth to continue, and we have a look at how they've performed. Click over to the summary tab. You can see here they consistently beat the analyst expectations. If you look at this graph here, Q1 2021, that's quite a big beat, even bigger, Q2 21, decent sized one there, and this last beat, really, really large. So 4 really good beatings of analyst expectations, and you can see the trend of the expectations is increasing. So I think this is this is really good news, indicative of good management. If you keep beating analyst expectations, there's good management, either because they're outperforming or they're managing expectations well, which gives them the opportunity to outperform. So that's very pleasing. Now, if you'd like to know, learn a bit more about kind of valuing stocks and reading some of the financial statements, I recommend the book The Intelligent Investor, and that gives you kind of a good overview of investing and ways to think about investing. So have a look at the link below, and you can buy that in the UK or US whilst supporting your local bookshop from the Finance with JCL bookstore. So if we have a look at simply Wall Street, just for a bit of a second opinion on a couple of areas. First of all, I mentioned the debt, and the debt to equity, although the debt's gone up, as we mentioned, if you look at that debt to equity, that still looks pretty healthy, so I'm less concerned about the debt. And again, looking at the balance sheet, a big debt number, but in the context of the balance sheet isn't a large proportion. And we talked about the dividend as well, so that's 3.5%. Now that looks like a payout ratio of just over a quarter, and that suggests that the potential for dividend growth is there. And they're saying future payout should increase to 35% by 2025. Even that still suggests there's further room to grow that dividend. So potentially, if things go as planned, or even better than planned, as they seem to do versus analyst expectations, I'd anticipate personally some dividend growth. Now, of course, this is just my own opinion. This isn't official investment advice, so don't go and act based just what I've said. This is my opinion of what's going to happen. Now, something to watch out for just when you're looking at sites, always do a double check of some of the metrics. Because actually, we said PE of around about 20 on Yahoo Finance, but if you have a look here on Simply Wall Street, they've got PE of around about 8, which is obviously a substantially different number. So if you have a look at Morningstar.com, which is great to have a look at some long-term financial history, you can see earnings per share here 7.42. If you compare that to the price, the 8 looks more accurate. And even in fact, if we go back to Yahoo Finance and we look at some of their statistics, they've even got diluted earnings per share of 7.42, and yet the trading P is 21.5. So do be careful when you're looking at some of these sites, because the numbers can be off slightly sometimes. So I think to me, the P of around about 8 looks more accurate. I certainly would trust Morningstar as a good source of information. So on that basis, that sounds pretty cheap, especially as forward PE that we have is 10 as well. So there's potentially some value there, although what the level of margin of safety is questionable, and that's something you'll need to think about. Now, just to close on the valuation, we're looking at 54 stock price. Simply Wall Street says 141, which is well over 100% upside. Now, that's just a bit of a back pocket view. I'm not saying that is what's going to happen, but it's good to get a view that suggests that from a PE basis and a dividend basis, that seems undervalued. They keep outperforming. And it looks like as well, this site agrees. If we have a look at what's expected to happen, they're saying 4% a year earnings growth for the next 5 years, which I think is a bit of a low ball, particularly if they keep exceeding analyst expectations. And if we close off with some of the price action, perhaps over the last 2 years, start of pandemic down to sort of 38. And in fact, it went down even further. And you're looking down here, look at sort of $34 per share, which you might say is a bit of a steal deal at that price. And fortunately, I didn't act or see it at that point. And there's been a bit of a recovery up to sort of mid-50s, drop back down again. And then since the sort of results, the last few months, we're back up to mid-50s. Now, historically, you can see that they have traded yeah, 2015, they did trade almost $100 a share. It's very important not to anchor to previous values, because just because it was 100 doesn't mean that was a fair price or the highest it could go, because price doesn't necessarily in the short term relate to the fundamentals. So although from the chart it looks like there's a long way to go, that doesn't mean it does. So do look at the fundamentals and the analysis to work out what you think is going to happen next. And my view is it will go up. I think it's one that should reach $90 to $100, and it does pay a nice dividend, so you can get some money in whilst you wait for that to happen. Certainly a good long-term investment from my personal perspective. So check that out, and check out the bookstore that I mentioned if you want to do a bit of reading on investing, and click on screen now to see where my portfolio is in relation to my long-term investing challenge.